G'day. Welcome to Lunch Money, your online and social media home for special situations, workouts, and capital raising professionals. My name is Nick Samios. I am the fund manager and director here at Hermes Capital, and I'm your Lunch Money host. So a very warm welcome to you. Today, I think we've called the episode Done Deals. We're talking about, we're going to take a look at the second tier / non-bank part of the commercial finance industry, looking at what's going on left of field, away from the major banks. There's a lot of movement in all different sorts of ways. Small businesses in particular, and are finding it the banking system more and more difficult to navigate. And aside from that, there's a lot of cheap money around. So there's a lot of new competitors springing up, and also technology is changing things as well. So the ways of doing business are changing. So it's a very dynamic field. It's a very competitive field, and I thought we'd actually explore that. And today we're going to be talking to Mark Hutchins from Secured Lending, a specialist mortgage provider in the non-bank space. And I'll introduce Mark very shortly. Before we get to that, I would just like to remind you to share, like, or subscribe to our podcast on your favorite platform. I think I'll plug Google Play today. If you've got an Android phone, jump on Google Play, subscribe to our podcast, and give us a rating. That'd be awesome. The other thing is, I just remind you that if you're watching live, if you pop a question, we will send you one of these lovely exclusive special edition Lunch Money mugs as your reward. Okay, well, without further ado, I will introduce our speaker today. Our guest is Mark Hutchins. G'day, Mark.
Hey, Nick. Thanks for having me on.
No worries. Now, you're sort of a part of my experiment of having just one guest. I've been told that when I have just one guest, that the conversation can get a little bit deeper and a little bit more engaging. So it's just you and me today, Mark.
No pressure.
We'll see how we go. Mark you've had secured lending for 5 years, I think, 5 years and a month,
Yep.
according to LinkedIn. Now, what's interesting when I sort of flicked through your LinkedIn profile, I mean, you started in Insolvency at the old Ferrier Hodgson, which is the breeding ground for many of insolvency person. But you went through PwC, but then you got into a bit of private equity. You say you spent a bit of time in private equity and funds management. So I suppose starting your own fund wasn't completely foreign to you. You've sort of been in and around that space in the past.
Yep. Yeah. I think it was. Also, there's a smattering in there of working at CBA in the workout area also. So kind of dipped my hand into both lending, workouts for lenders, and obviously the more broader insolvency assignments. So I'm still one of the owners of Corcordis. So I'm still within that business, but a fair bit of my time now is running, I guess, what you would call the family office of Corcordis, which is the owners of Corcordis. I run their money, whether that's private equity or debt transactions. Yeah.
Yeah, well, it's certainly a very interesting model. I suppose, in that regard, it's you're sort of ahead of your time because, insolvency is not quite what it used to be, is it? I mean, I'm sure that it will have a renaissance sometime soon, but as a business model, it has changed, hasn't it?
Yeah, I mean, it's obviously morphing, and no one in insolvency would be saying that it's heady times at the moment. Look, where insolvency goes for the next 12 or 24 months, I think, is anyone's guess. I think most people have got it wrong in the last 12 months, and they'll probably get it wrong in the next 12 months. So there's a lot of factors in play, right? And what the government does, what the ATO does, what the banks do, the liquidity environment, all of those things play significant impacts on how businesses behave when they're in trouble.
But meanwhile, I guess you got into this secured lending at a time when, there were other players in that space, but there wasn't a lot of players. There's a lot more now. And I suspect that, when this pandemic cycle fully plays out and the economic consequences fully play out, I have a sneaky feeling that it'll go back to the numbers that it was. I think a lot of these newcomers, when they actually start having, the first whiff of grape shot, I think things will change. But listen, I have skipped over my regular question, which is, what's been keeping you busy the past week?
We're really busy at the moment. So for the last week, we settled 5 deals, which for us is a fair bit in a week. Lots of bridging loans out there at the moment, so I think that's just being driven by the fairly hot property market at the moment, and we're seeing people effectively buy ahead of their sell on the property. And I think they're doing that because it's hard to find properties. They're getting snapped up quickly, and they think it's worth the punt to lock in their buy price and speculatively make sure, hope that they can get the right sell price. That finds its way into the private lending space because banks aren't great lovers of the bridging market. So we've been doing a fair bit of that stuff at the moment.
That's interesting. I mean, I get on Twitter a little bit, and I like to follow a bunch of guys that they're all, property doomsayers, to be honest with you, and various economists on the scale from professional down to amateur. And to hear you say that, there's a lot of people buying properties before they sell. I mean, just, that's a very bullish outlook on the market, isn't it?
Yeah, it is. I mean, it sounds unbelievable, but so normally you'll get a deal and the borrower will tell you what the property's worth, right? And so generally that's pretty aggressive number, and then you get a valuation, and then you take an assessment, et cetera, et cetera. We're finding, in a couple of these recent deals, where actually the borrower set a number, and then the actual valuation came in excess of the borrower's number. To me, that's bizarre. That just doesn't generally happen. But it is that hot where agents are saying, it's a week by week thing. I've got people lined up. What's the property worth in that type of market? Who knows?
Yeah.
How many crazy people in the room?
Well, it's interesting because we don't have necessarily the overseas buyers like we used to.
No.
Or do you? I mean, you're sort of closer to the property market than I am. Are there offshore buyers, or it's just local people that are?
I don't think so. Not from what I'm hearing. I'm hearing people are. Obviously there's a lot of different cycles within the one property market of Australia, but it's cashed up people that. I think it's the billions of dollars that would otherwise be spent in Europe and overseas and holidays and blah, blah, blah. All that stuff's just building wads of cash, and people want to do things. I mean, try and get a tradie in this market. It's tough. Try and get construction done on your house. Try and get, all that stuff. They're loving it. The tradies are loving this environment because we're all spending money. We're either pumping it into our houses, or we're flipping properties and buying another one because we're bored and we're at home more, and suddenly we need a bigger house. And the at home thing, I think, has probably generated that. I mean, that's definitely made the kind of coastal and Southern Highlands and all those kind of areas, which otherwise people would say, that's a holiday house. I think people are saying that's going to be my principal place of residence. I can live there now because I'm only working 2 days a week. So that's a big change.
Yeah, I mean, look, why the hell would you deal with the rat race of Sydney? Like now,
exactly.
one of my staff just told me that she was watching Gladys, and now we got to wear masks on the trains again. And bloody hell, okay. Yep. But, or I could be, I don't know, where did you say? Goulburn? You didn't say, where did you say? Down the Southern Highlands. Or, Central Coast, Blue Mountains. And
probably without a mortgage. Near the beach, blah, blah, blah.
So what am I doing here? And I guess, I mean, do you ever, does it, I mean, as a property lender, I mean, does it worry you that the market will suddenly run out of steam, and that house prices might collapse, or you just
100%. Yeah, no, 100%. I mean, I think the adage of when you're valuing properties, it's really dangerous to look through the rearview mirror. You should always be looking through the windscreen, right? And so look ahead and try and predict where things are going. In this market is very complicated. So I'm trying to value stuff in this market. Very complicated, right?
Well, we'll come back to that in a second, because I'm interested to get your thoughts on that. But I mean, in the US in particular, but also in Europe and arguably in Australia, if you wanted to destroy and this is where I get a little bit sort of tinfoil hat, so forgive me for this, but if you wanted to destroy the currency, I mean, short of just going into the Reserve Bank and setting fire to every note in place, the way that there's so much money being printed. Okay, I've lost track of how much is being printed in the States, and if currency is going to be run into the ground, then why wouldn't you? Property is probably a safe haven. People talk about gold as a safe haven. I don't see why property isn't a safe haven either. Not that I'm encouraging people to necessarily buy property, but what are your thoughts there?
Look, it's hard to argue it. I guess the question is, where are you going to put your money if you're not putting it in property? You're certainly not going to put it in the bank and get your 0.5 or God knows whatever else you're getting in a term deposit at the moment, not much. Obviously you look at the equity markets and they're pretty hot. So you're going to put it there? I don't know. I think Australians just lend towards the property as a backbone to where their investments sit anyway. So it's got a natural flow anyway.
Yeah, it's interesting. I was listening to Ross Greenwood this morning on Sky News, and he was talking about super funds. Apparently, the government's bringing a thing in where you'll be able to easily compare the returns of super funds. And a lot of super funds are getting 10%, and that's because they're invested in the market. And they made the comment, "Oh, well, if your super fund didn't get 10%, then you should switch." And I'm thinking, well, actually, that depends, because there is a risk return sort of profile, and we will talk risk return, but not right now. My producer's probably thinking I should throw up that graph, but not just yet. Now, of course, then there's cryptocurrency as well, which I like Warren Buffett's description of it as rat poison. But can't get
my head around that one. Can't get my head around that one.
No. And look, there's two guys. I'd like to think that both you and I have a rough idea of what we're doing, and we're not into the cryptos. So there you go. Now, of course, there'd be some 21-year-old who's probably made $500,000 out of the stuff. And
I had an Uber driver drive me 6 months ago and said that he was into it, and I thought that's not a bad sign for me not to buy.
Yeah. Well, Paul Keating used to say the pet shop parrot. So maybe the modern equivalent of that is your Uber driver.
Yeah.
And tell me, I asked you the other day about your valuations, and you said that you do them yourself.
So we've effectively got a valuation business that sits within us that we leverage, and right. They do all our own assessments. So yeah, we don't have to send a valuer out. We've got the right people within the business to do it. So that's us just trying to be fast and nimble, and I guess we can do that because it's our own money. So we don't have to conform to someone else's box about how we lend.
So it's an in-house capability as opposed to a DIY. If you So wouldn't be like me doing my own vals personally, going, well, I reckon. No. You've got someone.
I've got a valuation business that works within our business, and they make the assessments for us and help us.
I'll worry a little bit less about you in that case. What and how do you find that their assessments compare to, someone wants to do a deal, and very often they've got valuations. The bank did a valuation 3 months ago, or the local agent's done something. And do you find that you're generally on the money with them, or you generally, how do you?
Yeah, look, I think in this market it's harder just because last month or 2 months ago, 3 months ago, vals generally the price has gone up. So it's just that function of thinking about sustainable deals and sustainable valuations. If you're going to be in a property in a deal for 12 months, you've got to think about that cycle, because you're taking a position in a property for 12 months. You're not taking it in today's hot market for 1 month. So it's, tenure of loans, volatility of the market, and I guess making sure you're taking positions that are sustainable.
And with respect to competition, are you finding that you're competing head-to-head for deals with other, lenders such as yourself, or are the brokers discerning that they know that if it's for you, it's for you, or when something lands on your desk, it's just generally yourself, or are you in a drag race?
It depends what the driver is to the deal. So around speed, we could fund a $10 million deal in 24 hours, 48 hours, right? And so that capability, there's not much of that capability. And so if it's leveraging to our strengths, then generally we'll be probably the only one around. Big seconds, very quick. It's us. And there might be one or two others that are trying. And then that's brand and making sure that you position yourself correctly, you behave correctly in the market. And as you would know, Nick, there's a ton of people that pretend they've got money, and then there's a ton of people that have money, but you wouldn't want to be at the end of the deal when, if things don't match up. And I think we've seen a fair bit of that in the market. There's a lot of deals being priced at just crazy returns on the way in. But as I try to tell the brokers, judge a deal by how much you pay when the deal's repaid. And a lot of our deals end up needing extensions, and they come back for additional money, or things change and things vary. And so that should be priced in, I think, when you're thinking about decisions, because I see a lot of borrowers getting hurt in this market because they've gone for the light deal at the beginning, and the guy that put the money out, he's not making any money out of that money coming in. He's banking on you not paying at the end, and then it's not pretty.
Yeah, well, look, I mean, I guess it raises a number of questions. I'll just note we have got a question on cryptocurrency, which we'll come to. So I've got an anonymous.
Is that because we said we hate it and we know nothing about it?
Well, I'll quickly show the question now, and then we'll come back to that topic that you just raised. But it says, "Hi both. You mentioned cryptocurrencies. Are you aware of the advent of DeFi, decentralized finance? This effectively removes the middleman. So maybe something to look into and study." I'm not familiar with DeFi. No. Is that that's not? No. Yeah. I mean, I guess in our own ways, Mark, we are both into disintermediation in as much as we make our own market. We're not going through the banking system, so to some extent, I don't know if we're DeFi'd or not. So let me tell you one of the beefs that I have, and I wonder if you come across this as well. I mean, you've, as I say, you've been doing it for 5 years. You've got a track record of completing deals, and I see your LinkedIn posts, where you. Your little brags, which are great, because that's the way people know that you're doing stuff, where you say, listen, we've just done a $7 million deal in 36 hours or whatever it might be. One of the issues that I have, and I've got one right now, where the deals come to us, and the deal should have come to us in the first place, but it's gone around the world, and one of the places it's gone is to a broker, not the broker that's brought it to us, but a broker who promised the world, was not able to deliver, but along the way they've taken security over trucks and property. Do you find much of that?
Yeah.
Where all of a sudden, not only do you have to pay out the bank and provide the money for the bridging, whatever it is, but you got some other broker that couldn't do the deal holding their hand out for 30 grand in.
Well, two things I see. I see the first one, which is. Brokers that pretend they've got money will put out a deal and then obviously not deliver it and come up with some reason, and then try and hold a caveat to extract 100 grand or whatever the hell the number is that they're saying that they're owed. So that's the first one. And then the second one is where a funder says, here's the term sheet, and then says subject to val, gets the val and then crushes the val and then says, I know you wanted 3, but I can only give you 2. And then the client says, well, that doesn't work for me. And they go, well, we're still offering it to you, so we're going to put a caveat on. So they're the 2 things. And then by the time we get there, then you're like, well, okay, now I've got to deal with probably some broker issue. I've got to deal with some lender establishment fee, and it's the spiral of death for the borrower.
Yeah, I mean, I saw one a year or so. It was just before COVID, and there was, it was just there was $200,000 or $300,000 worth of fees for nothing. And I say, look, if you say to the client, I can deliver a deal that looks like this, and you deliver a deal that looks like that, and the client changes their mind, I think you're entitled to recover some of the costs. But if you change your mind and you're suddenly offering half the money, well, you're not delivering. The other thing along those lines, I suppose, is of course, when they do come to you last, I get the deal where that they've had bad treatment from 2 or 3 other brokers and lenders, and then I say, okay, well, I can look at this, but I'm going to need to value your trucks, and that's going to cost $5,000. They go, oh yeah, but I already paid $20,000 to the other guy.
Here we go again.
Yeah, I know that, but unless you get the other guy to pay for my valuation, you get a bit of that as well.
Yeah. And I mean, they're exhausted sometimes by the time they get to you, and they've been stuffed over by so many different people that I get it. I actually get it. So.
Yeah, I think the lesson is, and look, I know we're sort of self-serving here, but you've got to deal with people that have got a bit of experience. It's as simple as that. I also worry about some of these new lenders. We've seen deals where, again, 2 or 3 years ago, you would have had to pay out the bank and maybe provide a bit of extra working capital, but now you're paying out the bank, plus you're paying out fintech number 1, fintech number 2, fintech number 3, and even some mortgage lenders, they don't really seem to have a handle on the way things work. And are you seeing a bit of that as well?
Yeah, I mean, there's the Prospers and all those guys, all these little fintechs that give small loans with no information. You end up having to roll up all these different lenders. I mean, probably more relevant, I would have thought, maybe to you, just in terms of the way your GSA structuring and all that. For me, I'm generally more skewed towards the property. But yeah, I mean, I see a lot of those businesses with tons of those little guys, all little loans, everyone just having their own little bite within there.
Now, let's have a look at just sort of on the topic of competition and new lenders and what have you. I've got a graph here. This is a very rudimentary graph that I stole from the internet, the yield risk return graph. And, it's the idea is obviously the higher the risk, the higher the return. And, I've been talking to a lot of, funds and private lenders who are complaining that they're seeing deals. They don't necessarily, the risk is high. They want to price for risk, but there's some newcomer who is maybe looking at the deal less, like you said, not looking at any information, not really appreciating the risk, taking on more risk and doing the deal at lower rates. I guess you were saying that you've done a bit of a study of the compression in rates, or you've got a bit of anecdotal feel on that?
Yeah. I was just thinking about, so 24 months ago, the cash rate was 1%. Cash rate's now 0.1, right? And so 900 compression. And then I thought about, well, what is that compression? How has that looked in our market in terms of doing deals? And so I would say 2 years ago, first mortgage rates, private lending space, it would be pretty hard to get a first mortgage deal in the private lending space. Remember, probably 8%, 9%, something in that.
That would have been attractive rates.
Yeah. And so that's probably the standard type of rate and now in this market, I would say that you can get, depending on the deal, but there are deals being done in this market at 5s to 6s, right? And so you look at the differential in that compression on one side and the other. Then what does that tell you? I mean, it tells you the differential in private lending to bank funding rates is very low, so not a significant difference. The second thing I think it tells you is, and I think it's really started to compress in the last 12 months. I think a lot of that money sat out. It sat in the term deposits. It stared at the ceiling and said, no, I need more money. I need more return. And then it's now thinking, well, I'm going to have to take a return. So I'm seeing a lot more people. I've had a lot of people come to us and say, can you manage our money? And those conversations 12, 24 months ago was, I need 9%, I need 10%, blah, blah, blah. That conversation now is, I'll take 4s, I'll take 5s.
Yeah,
so
don't make me take 0.5% that I'm getting at the bank.
Yeah, exactly. So that weight is coming in.
Yeah, I mean, I guess if let's say you've got 10 million bucks, and who's got 10 million bucks? 0.1% of the population. But you've got 10 million bucks sitting at the bank. You're earning 100 grand a year. You're not keeping up with inflation. It's so, and the banks want the money anywhere but on their own balance sheets. They want it out. They don't want deposits. The banks are actively discouraging depositors. And you talk about, investors a few years ago. I mean, there was a time when, when we started our business, you had to go around, please, sir, can I have some money? These days, getting investors is not the issue. It's if they can put their money anywhere but the bank, then they're happy with that. The stock market's been performing, and
I was going to say, I think the asset class generally, was a bit stinky a couple of years ago with all the pooled mortgage funds falling out, all that kind of stuff. I think people probably retreated, but I think now it's becoming a lot more of an I guess there's contributing mortgage schemes. Some of the structuring has fixed some of the issues, I think, within the funding into this asset class. But I think just more generally, people are now looking at it and saying, well, so I can get 4 or 5% and probably be 70% of the property market in value. That feels like an okay trade in terms of risk and return.
Yeah. Now you obviously spin deals around very quickly. You sort of turn around more or less in 24 hours. But I know that I've seen a few articles of late, and I've got one here where Judo Bank has been complaining. They're in a different, obviously in a very different space to you and I, but nonetheless, they might be looking at taking out one of the big 4 banks, and they're saying it's taking up to 60 days to be able to coordinate a refinance. Are you finding that as well?
Yeah, and it probably drives 2 things for us. So that slow pace on exit probably drives more seconds to us. So we've done a fair few seconds in the last 3 months, and that's just because if it's going to take you 60 days to pay out CBA or whoever it is, but you need the money and you can't wait 60 days, then your options are take a second to deal with it or refinance the whole piece. So that's driving the second market. The flip side of that 60 days actually is that time frame, that kind of stalling and speed issue is on the other side also, which is the application side. And I think for us, that's driven, again, that drives someone buying a property, someone doing a transaction. Brokers are telling me they would have, say, 24 months ago, they would have a response from a bank, 1 to 2 weeks. Yep, like the deal. What about this? What about that? Let's go. That time frame now is up to a month, and that up to a month isn't, here's your signed approval, let's go. That's, yep, got it. Thanks for that, Barry. Looks okay. What about this? What about that? So, these time frames are ridiculous, really, in this market.
Yeah, I guess traditionally the deal would go to the bank, and let's say it's a manufacturer of blue widgets, and the bank doesn't like manufacturers of blue widgets. They look at it straight away and say, listen, never mind what's in this deal. That industry is not for us. But now it's taken them, 21 days, 30 days just to say, oh, no, we could have told you if we just looked at the file.
Yeah.
We don't do blue widgets. Yeah, so that's definitely an issue. And yeah, so that certainly makes them stickier. Now you were saying that one of the big drivers for business for you at the moment is bridging, this bridging stuff, particularly where people are buying properties. So, that would account for why the property market's red hot. So obviously you're busy in that space. I mean, what are the drivers for you more traditionally? I mean, like for example, ATO or any of that sort of stuff. Like in our space, it's people getting in trouble with the ATO, and that's a symptom of cash flow issues. I mean, what is that a driver in your space, or?
Yes and no. So probably not in the last 24 months. Although I had a look at the deals we did in the last 3 months, and so we've probably done about four of them. I would categorise as kind of lens into insolvency practitioners that are doing restructures in the background. So, so they're not going to push the button on an insolvency. They're in the background helping businesses kind of recapitalise, and there's a property element to that. And we're coming in and giving the effectively the cash flow to allow them to deal with the issues that they've got from a creditor base. So a fair bit of that. I haven't seen the kind of ATO pressure debt issue yet. I don't know whether you're seeing that in your world yet, but I haven't seen a great deal of that pressure yet. It must be out there. But,
look, I was talking to someone yesterday who does a lot with the ATO, and said that the ATO, I think the ATO is reading the paper and saying that the economy is theoretically booming. So I'm told they're back to business as usual. And not just back to business as usual on pre-COVID debt, but just across the board. So that'll take some time to manifest itself, but I'm assured that's definitely the case. So really, a lot of your business is more it's property industry transaction based. You're saying before we went live that you're not necessarily doing a lot in the development space.
No, I mean we probably our niche would be part complete developments. So we often come in at the end of a development where there's been either an issue or they need a couple of $1 million to finish it, and they don't want to go back to the bank because you don't go and ask for things halfway through the process with the bank. So we do a fair bit of the part complete developments. That would be a niche for us in the market.
So you're taking a little bit of completion risk there.
Do you know what? I like part complete developments way better than developments out of the ground. I mean, my brain looks at it and says, you're out of the ground. I can walk into the building and feel the finishes, so I know now the quality. I can line up most of the certifications in the build, and I know. Maybe I'm 6 months out from finishing. I roughly know what the pre-sales look like. I know what financing market they're settling into, and whether they're in or out of the money, and the likelihood of people selling. So I love the kind of part completes. A lot of other funders hate them because they think there's an implicitly higher risk in it. I kind of think of it the other way around. So we don't do a lot of from woe to go construction funding, just because there's tons of people in that space. We'll do them now and then, but there's tons of people. So I don't need to be in a market where there's tons of people fulfilling it.
No, look, I mean, one of the reasons I don't touch development, and there's, it's just not what we do. But I also think that if a development is crossing my desk, what is it? Who are the 10 people that are actually in development that turn the deal down? And they're experts. And they know where to look for the spiders, and I don't necessarily know where to look for all those spiders. But I guess you're saying, look, once it's out of the ground, and once you've got a name, once you've got a reputation for being able to step into those situations and get them completed, then happy days. Listen, Mark, we're beginning to run a little bit out of time, so I want you to pull your crystal ball out and tell me, how do you see the rest of the year playing out? We're sort of nearly at the end of the financial year. How do you think? What's the run into Christmas going to look like, do you think?
Well, I think for us, look, rates aren't going anywhere. That seems clear. So I think a ton more money is coming into our private space. So is there going to be more compression of yield? I don't know. Potentially. I think we'll be busy up till for the next 6 months, just because I still think this property cycle's got a way to run. when none of us are going overseas potentially for the next year, 2 years, that's just a heavy weight of capital that's going to be bored and looking to do something, and most of us do something with property. So I think, I think as long as the property market's moving and there's and it's transactional, we spit off the back of those transactions. So I think we'll be busy for the next 6 to 12 months. Are we going to love the yields floating around? Maybe not. I probably loved them better 24 months ago. But I'm hoping your prediction, Nick, of all these cheap guys coming in who don't know what they're doing. Let's hope maybe Core Quarters is doing their insolvency in the next 12 months.
Well, the thing is, in the lending business, the easy part is lending the money out. The hard part is getting it back again, because nobody ever think. Well, very often they don't think they don't think they have to give it back. Or people don't think through the consequences. And I think one of the problems is that a lot of these pop-up funds and pop-up mortgage lenders are thinking, well, what could go wrong? I'm lending 80% of the value of the property, and I'll tell you what, even if property prices just don't go anywhere, or property prices still increase, if it's going to take you 2 years to realise on a property, watch what happens to your returns then. So all right. Well, look, thank you very much, Mark. We had enjoyed chatting to you. Do you get out of the office much, or are the deals just sort of flowing into your inbox, or do you find yourself getting out and about, or how does it work?
Yeah. So I kind of get around the country a fair bit. Probably a third of our deals come through our, just call it the Core Quarters Group network, and then the rest come through brokers, and it's a bit of a mix.
Well, I hope you haven't been to any Redfern or Vaucluse cafes.
I'm flying out to Northern Territory tomorrow to go to Kakadu for 2 weeks. So that's unless Gladys tells me that I can't by the end of today, I think that's where I'm going. So
well, good luck. Oh, well, very good. Well, good luck with that. You'll have a great time. All right. Well, thank you very much for joining us, Mark Hutchins from Secured Lending. It's been wonderful. Thank you. Cheers.
Thanks.
Bye-bye.